Hey, good morning, everybody. It is Saturday, and this is Multifamily Unplugged. Welcome. And if you are here for the first time, I am certainly glad that you're here and thank whoever invited you for sure. If you're watching us for the first time or you've been here before, you know what? I'm just going to ask you to please, go to social media, like us, love us, help that algorithm. If you're watching us this morning on YouTube, smash the subscribe button. We're continually bringing you good content, relevant content for where we are in the marketplace today. Glad that you're here this morning. Hope you're being intentional about your weekend, whatever you're doing, whether you're working or spending time with family. My guest this morning, Jacob Clopton. He's with Clopton Capital here in Chicago, and I'm bringing him in, and we'll get going here. Jacob, good morning.
Good morning. Thanks for having me on, Mike.
You bet. How you doing today?
Good. Hope you're well.
Good. Hey, so I always start my show out with that one question. And I always tell people, I say, hey, I'm going to write a book one of these days on this because I've asked probably 300 times now this one question. But in one word, what best describes you personally and professionally?
That word I would say is grit. Just being able to continue to charge forward in the face of anything that comes at you. I think that describes really well kind of my business journey and a lot of my personal journey as well.
Grit. I love that. I always find it funny because I think maybe one or two other people have used that word, but do you think that comes from your upbringing in that? Where'd that come from for you?
I think it's both, right? I think it's the nature nurture thing. I think, you have it in you to a degree, but then also your experiences bring it out of you. So yeah, I'd say both.
Nice. Well, listen, let's talk a little bit about your history and how you got into what you're doing today and what got you in this space.
Sure. So what we are today is a commercial real estate services firm. And I've dialed that all the way back to when this started, 15, 16 years ago, which was, 2007, 2008 credit crisis. Back then I was trading interest rate hedging product futures, like 3-month LIBOR and Fed funds. And obviously it was a credit crisis that the whole lending market evaporated overnight. And those are, lending products. And so that really just went away. So really need to find something else to do. At the time I was kind of considering moving industries anyways. But it being a credit crisis, the idea I had was to start a company that found people lending and credit. It wasn't really specific to commercial real estate at first. Really just started making cold calls to banks and anybody I could that I thought, might lend. And at the time, you would just find people that had money to lend and then put that out there and people would just come, right? I mean, there really wasn't a lot going on in the lending market. Since then, it really just fell into the commercial real estate space because it just fit really well with what I wanted to do. And then over time now, we're in lending, insurance, we're real estate brokerage, 1031 QI, and we do commercial solar. So it really expanded from there.
Wow, interesting. So when you say commercial solar, you're lending on that?
No, we're actually doing installation.
You are?
And we arrange financing for it as well.
Okay, interesting. So let's talk about credit crisis for a minute.
Sure.
And your time frame when you were trading before, and the credit crisis. Are you back talking about 2008 or after that?
2008.
Okay.
Yeah.
And so I wanted to pre-frame that for the audience because of my next question. So my next question is, what do you see in today's market that is the same that was happening in 2008, 2009, or different? Are you ready to skyrocket your investment portfolio and leave a legacy? Are you tired of inconsistent returns received in the stock market? Do you think it may be time to take a look at alternative investment options for your portfolio? Passive investing in multifamily real estate could be that option. With no tenants, trash, or toilets,
providing a solid return on an annual basis that outperforms traditional investing, also receiving a monthly or quarterly return along the way. These lower risk and secure assets are a great hedge against inflation. If you want to learn more about these types of opportunities, you can email me directly to schedule a 15-minute consultation to see if you qualify. Just email me at mike@mikemorawski.com.
To me, it's very different. I mean, banks, generally speaking, are very healthy today. Very healthy. They have strong balance sheets. And you really haven't seen anything remotely close to what happened in 2007. I mean, in 2007, the floor dropped out, right? And there was a residential crisis mainly, right? And there was just, you couldn't sell assets at any level, right? Assets being homes, right? Today, that's just not the case. I mean, there's so much money lined up to buy property at the right basis. You know, so there's still very strong demand there, and there's still a lot of liquidity in the system. We created, you know, how many trillions of dollars during COVID? I think in 2 months, or something like $4 trillion, and the same amount of money was created, I believe, something like 5-6 years during the teens of the 2000s. So, you know, that money expansion was just astronomical. And even with the Fed raising rates and kind of trying to suck some of that out of the system, which they have, right? There's been a lot of money that's left the system for sure. There's still a lot out there, and there's still a lot of private equity money out there chasing deals. In the banks today, there's no question that at the local regional level, there is some pain with some of these depositories. You know, we arrange loans with banks every day. And I think, you know, people are getting responses from banks today that they just didn't think was possible. I mean, for instance, when you go ask some bank for a loan and then they ask you for a loan first in the form of deposits, I think some people aren't really used to that. But, you know, it's very interesting because some are in a tough position and they really just can't lend. Doesn't mean the bank itself is in trouble at all. You know, we haven't seen asset deflation, you know, in real estate to a level that it would really affect bank balance sheets. But there are some, you know, banks out there, probably about 30-40% of them that are very healthy and have good deposits, and they are actively lending. I mean, just last month, we closed 4 bank loans. So, I mean, there's absolutely money out there. Does it take more phone calls? Yeah, it's harder to find, but it's absolutely out there. I just don't see a credit crisis anywhere on the horizon.
Yeah, interesting. You know, you mentioned bank failures early on, and I just, you know, has there been any bank failures this round? Do you see any coming? You know, you hear some noise out there that there's some banks that are in trouble, but is that truly the case?
Yeah, I mean, Silicon Valley Bank's a big one, right?
Right.
They were really, you know, a victim of mark to market. They had poured all this money, from what I believe what happened, they poured all this money into treasuries. And then when, you know, the treasuries, you know, took a dump, the value of those T-bills went down and, you know, they really got hit. There are, and I'm not going to name names, but just calling, you know, hundreds and hundreds of banks and speaking to hundreds of bankers every week, there's some banks that are in trouble. Probably ones that people don't think about yet. But the banking system in general is very healthy. And realistically, if any banks fail, they're just going to get crammed down the throats of the larger banks. And those ones are going to get bigger. You know, so I mean, I think there's safety nets in place, and there's more than enough liquidity in the system to take care of any, you know, bank failures that we see from this point forward. On the local regional level, you know, a lot of the local community banks perfectly fine, don't really see, you know, a huge problem with those types of guys. The regional ones tend to be where you know, there's a lot of potential pain. I think a lot of banks increase their asset bases pretty quickly. Through a lot of commercial real estate lending. And, you know, the ones that have that type of exposure, you know, particularly in some asset classes like office, places like that, where they're doing, you know, high leverage lending, those are the ones that are going to get hit. But generally speaking, you know, I think the banks are going to be just fine.
So is this market cycle that we're in? And I want to reiterate to listeners that we are in a market cycle, right? That real estate cycles up, cycles down. Those cycles can be 8 years on either side. They can be 10 years on either side, but we're on the downside of this market cycle. And is the bottom going to be as bad as some of the doomsday experts out there have said? Or, what's your perspective on a bottom? Are we in the bottom? Are we near the bottom? What are you thinking as far as, coming back up on the other side?
Yeah, I mean, there's a lot that goes into this, right? I mean, one is credit. I think there's more than enough credit out there, to actively lend. There is, the health of the general economy. And if you really look at where things are, we have very high employment. I mean, generally speaking, there's lots of jobs. People are employed. The GDP growth is pretty good. I just don't see a lot of distress in the economy. I think, to get a better feel, you've got to get a little bit more granular as, instead of just real estate, right? Start picking apart different industries. And when you start doing that, you can see where, there is going to be, some distress. We have seen some lower appraised values coming in, especially in the asset classes that people probably expect. Office, for one, right? Places like that. There's going to be a lot of distress. Commercial real estate has a really interesting way of always kind of remaking itself. So we're seeing, for instance, lots of people trying to turn office into multifamily, stuff like that. I think the third prong here is cost of capital. And let's see what happens in September. But all things being equal today, it looks like we've seen peak rates. And as the cost of capital continues to come down and things normalize more, you're going to see, cap rate compression and value goes up, and more lax lending. I mean, commercial real estate at the end of the day, it's just a math problem, right? And today, the reason why there's a lot of just stalling in the industry is because that math problem doesn't really work.
Yeah.
You have, SOFR above 5% and the prime rate at 850, right? And the average rate we see from banks is between 7 and 8%. So that's hard to make that math problem work. But as it comes
and explain
out,
why. Explain why, though.
well, I mean, listen, cost of capital is an expense line, right? And when you increase the cost of capital, each property itself, considering you buy it at the same, level, you're going to be able to afford, less loan dollars. And so when you have less loan dollars, you need a lot more equity. So you can see how a lot of, it's hard to get 75, 80% lending, when you're, 7%. I mean, think about what cap rate you have to buy it at that. You have to buy it above a 7 cap just to get positive leverage. So, I mean, that's where it gets hard. And especially multifamily, I'm still seeing multifamily trade at, low cap rates. Multifamily typically trades at 215 basis points over the 10-year. And, what's really difficult today is you have actually yesterday, I think it finally flattened out, but you had an inverted yield curve for so long, right? Like short-term rates were above 5. The 10-year was 4, 3, 3.5, high 3s, somewhere in there. And so, you still in multifamily, if you think about it as an asset class, so long-term asset class is going to trade over long-term treasuries as an index. So you have cap rates that are still pretty low, but a lot of lending that has very high rates. So, that type of relationship is very difficult to make deals work. It just takes a lot more equity, and a lot of people just don't have that because, it's hard to get good equity returns when you have to come in with 40% equity and your cost of capital is very high.
Yeah. Well, that's another thing when we talk about equity. It seems that today raising equity, raising capital is a little bit tougher than it's been, 2 years ago and especially 4 years ago, right? But why is that? I mean, there's a lot of dry powder on the sidelines. What is people's hesitation today with equity?
I think personally, the hesitation is everybody's waiting for something to happen, right? Waiting for the recession to happen, waiting for the downturn to happen, waiting for something. Maybe it happens, maybe it doesn't, right? But if you are, for instance, running a fund manager and running an equity fund that invests LP capital into projects, if you invest ahead of whatever you think may happen or the probability of something may happen, and you end up, making some pretty bad investments other than just, waiting and seeing, you can kind of see how, that would be the reason why a lot of these guys would wait. We deal with a lot of institutional LP funds and family offices. And I think, a lot of people are seeing them want to look at deals and see what's in the market, and not really executing on a lot. I mean, if your yield on cost is over 8%, I'm sure we can get equity, right? But a lot of deals don't pencil that way, especially when you're talking about construction. Right? I'm saying the yield on cost of a lot of construction deals in like the sixes, and it's hard to make those types of equity returns work. So I mean, for the right deals, there's equity, but those are harder to find.
I always tell people you have to watch that, your return on your capital on your renovation costs, because that's a big proponent too of where the deal's going to go. So, it's interesting. Cost of capital fluctuates so much, depending on where you're at in the market cycle. But what I find really strange is if we know that we're going to have a soft landing, because if you listen to some of the economists today, they're all saying this is going to be softer than expected, and that maybe we're not going to go into a recession. And now you're already seeing things like gas prices come down. And I know the election's coming up, but you got gas prices coming down. You've got interest rates that are coming down, that are projected to come down at least another 50 basis points before the end of the year. Why do you think that the average person would say, well, I'm still going to wait for a better deal or something better out there, when you could position yourself today in front of the next bull run? That's how I look at it. I've been doing this 30 years. So I say, I don't think we've ever seen another time in history where it's not going to be so bad, but we're coming out of this cycle, and, this is a great time for repositioning of wealth. And, let's get going.
I agree. I think it comes down to just the human psyche, right? On average, people fear loss more than they value gain. And when you're you're trying to evaluate, like, is it going to be a soft landing? Is it going to be a hard landing, right? I think people get more risk averse, and more afraid of the hard landing than they do when evaluating, like, whether or not it's really going to be a soft landing and it's going to be just another, period of long-term, capital gains and appreciation.
Yeah.
I think most of the indicators are, pointing towards a soft landing and not a hard one.
Right.
But when a crisis happens, you don't see it coming, right? That's what I try to tell people too. Like, listen, you're waiting for a crisis, but you don't see a crisis coming. It comes out of nowhere. That's the whole point, right? That's the whole theme.
That's why it's a crisis.
That's why it's a crisis. You can't prepare. Yeah. The thing is, whatever you're worried about, it's a black swan. It's out there. Maybe it's out there, maybe it's not. But it's hard to, it's hard to put that math problem to work in real time, because you're either so worried about it that you get paralysis, or you get over it and you look at what's actually going on and you make the judgment call based on that.
Yeah. So listen, I know that you deal with a lot of banks. Do you do any agency financing?
Absolutely. Yeah.
Okay. And are you just a local lender to Chicago, or where can you lend?
No. So, we're a capital markets firm, so we can really operate anywhere. And the vast majority of our clientele are not in Chicago.
Great. Awesome. And is most of what you do on the commercial side or the residential side?
We are exclusively commercial.
Okay, good.
So residential, to caveat that, we'll do portfolios of SFRs and, 1 to 4 units, but that's still really feels more commercial. But no, we don't do any owner occupied or, where people actually live inside the house.
Yeah. What do you want to tell investors today about the market and about taking that next step forward?
I would tell them, I think times like these are really the times to take opportunity. And if you look at just specifically where rates are, and the powers that be are telegraphing so, visibly that rates are coming down. I think just that alone, getting in front of that and knowing that that's coming, you're going to see property appreciation going forward, even at the baseline. Even if you don't increase NOI, right? But if you're able to get into a value add today, you're going to have a lot of tailwinds. I mean, you're going to have a lot of tailwinds just in, lower cost of capital, cap rate compression, but then also whatever you're able to do with the property. So there's a lot of reasons, to really start looking now and start putting, boots on the ground and testing out deals and seeing if they work.
Awesome. Well, listen, I appreciate you being here today.
Yeah.
How do people get in touch with you if they want to talk to you a little bit about capital, whether that be debt or equity?
Well, Mike, I'm exceptionally easy to find. Find me on LinkedIn, Jake Clopton. Go to our website. Give us a shout directly. I'm around anytime.
Awesome. Jacob, I appreciate your time this morning. I appreciate you being here. Any big plans for the weekend?
Probably hanging out with family. I have 3 kids, and they take a lot of time.
Nice. That's for sure. Okay. Hey, listen, I'm going to move you out and say goodbye. If you want to just hang with me in the back room for a minute, I'll be right there.
Thanks so much.
Yep. Hey, everybody, that was my show this morning. My guest, Jacob Clopton. Look, if you're looking for a lender or some equity conversations, give him a call. He definitely is a smart guy. And you know what we say about relationships and people that are in your room, that you want to be in a room with smart people. So a lot of information, a lot of knowledge. And I'd go back and listen to this a couple times because there were some really good golden nuggets in this morning's episode.